Hello everyone, and thank you for watching my West Summerlin update video for October. As a 10-year resident, these videos are dedicated to the current owners and potential buyers in West Summerlin. Today, I'm going to cover this month's sales and compare them to last year. Then, I'm going to cover the current inventory levels in West Summerlin and break them down. Last, for the first time, I'm going to take an important excerpt from my Las Vegas monthly update video, which explains how and why the overall market is heading for major decline. So first, let's take a look at last month's sales numbers. For the first time in ages, sales dropped to only 28 homes sold in September. This is a 15% decrease from August. Now, the median sales price this September was $365,000 versus about $249,000 last September. I had to run the math on this a couple times, but yes, from this year to last year, the median sales price in 89138 was up 46%. Yep, that sounds reasonable. Now, let's look at the current inventory. Right now, our available inventory of homes under contract has jumped up to 61. Now, back in June, we only had 18. So our inventory has jumped 340% in only 4 months. The good news is that this month we only increased 7%. So hopefully the inventory increases will slow down. Now, like I mentioned at the beginning of the show, for the first time, I'm going to incorporate a segment from my October Las Vegas market update video, where I cover the issues facing the overall market. So let's check out that segment now to close out the show. The tides of change. This is where I explain to you how and why the market is declining. The big news in September was in regards to Wells Fargo and Citibank. Now, Citibank laid off 750 people alone in their Las Vegas mortgage division. Wells Fargo laid off 1,800 people, and that's after they announced 3,000 layoffs back in August. Essentially, these banks are watching mortgage applications just decrease and are proactively responding. So the moral of the story here is, if the banks are betting against housing by laying people off, what do you think is going to happen next year? Okay, so speaking of banks and mortgages, this is potentially the most important topic I'm going to discuss, and nobody is even talking about it yet. Okay, so back in 2010, Obama signed into legislation the Dodd-Frank Act. Now, this was supposed to reform Wall Street and protect consumers. Well, as part of this legislation, FHFA, which stands for Federal Housing Finance Agency, had changed what they define as a qualified mortgage. Essentially, the government wants to limit the risky types of loans that are purchased by Fannie Mae and Freddie Mac. So starting on January 10th of next year, some pretty big changes are going to happen. Basically, the government is limiting how much lenders can charge up front to 3%. They won't purchase any loans with terms over 30 years and a few other restrictions. But here's two major changes that will have a large effect on our market. First is the debt-to-income ratio. Right now, the debt-to-income ratio is at 54%. This means that if your family makes, say, $10,000 a month, the sum of all your monthly obligations, including your new mortgage, cannot exceed $5,400. Well, on January 10th, this number is coming down to only 43%. Now, this is huge, especially in Las Vegas. Many buyers have high debt-to-income ratios. Dropping a borrower's debt-to-income ratio 11% is like telling a person who qualified for a $400,000 home in December that they only qualify for $300,000 in January. This is going to be a major issue in January, and most people won't even know about this till the media starts reporting in probably like December. Now, speaking of the amount that people can buy, FHFA is also in charge of what's called the conforming loan rate. This is the maximum amount a borrower can mortgage until it becomes non-conforming, or in this case, a jumbo loan. Typically, jumbo loans have lower debt ratios, higher interest rates, and increased down payments. Most buyers typically do anything they can to avoid a jumbo loan when they have the means, or if they just find themselves close enough to that limit. Well, right now, this amount is $417,000 in Las Vegas. Now, back when the market crashed, there were threats to lower the conforming rate since home values had plummeted. Well, now that the government wants to reduce the types of loans that they purchase, FHFA announced that they are planning to reduce the conforming loan limit. We don't know what amount or when they will announce it, but that could go into effect January 10th as well. So now it could drop to only $400,000, or it could drop to where we were back in 2005 at $360,000. So either way, any reduction doesn't help the housing market. If they reduce it back to $360,000, this will wreak havoc on any seller in the $400,000 price range. Okay, next has to do with hedge funds. Now, we all know that the hedge funds have been buying up about 4,000 plus homes in Las Vegas a year for the past few years. Well, originally, they stated that they would be holding these properties for like 5 to 7 years. Last month, when Colony Capital tried to go public and securitize a small portfolio of theirs, it came out that they only had a 60% occupancy rate and essentially failed to get the rating they needed, and then just bagged the whole idea. Well, this past month, Oaktree and their partner, Carrington Mortgage Services, which controls about $76 billion in real estate, announced that they were selling off their properties, most of which are located in the western states. So this leads us to two questions. Why would you sell now if you think the market is great? Now, my answer is that they realize the market is going to get worse. So get out while you're ahead and take your profits while you still can. So question number two, who's next? Now that Colony Capital failed to go public and securitize, will they bail out and sell? Blackstone has been very quiet in Las Vegas recently, and they're the largest hedge fund. So if prices begin to drop, are they going to bail out too? Okay, so last topic. For months I've been stating that new homes are going to get absolutely crushed when the market actually turns. Now, I've said that you're borderline nuts to purchase a brand new home right now with new home prices so inflated above the same resale home with a pool even. I said watch. Next year, new home builders are going to be giving away homes when people wake up and see what's going on. Well, guess what? As you can see now on the screen, this is a spreadsheet from September 6th presented by Home Builders Research, which shows the sales from all of the new home builders. So, although it's missing about 3 weeks from the completed quarter, you can pretty much get the gist here. Let me run down some names and show you what kind of impact the market has had on them. American West Homes, 222 sales in the first quarter, now 106, down 52%. Beazer Homes, 116 in the first quarter, now 42, down 64%. Del Webb, 67 homes in the first quarter, now 22, down 67%. D.R. Horton, 247 homes in the first quarter, now 85, down 66%. Harmony Homes, 136, now 67, 51% decrease. The list just goes on and on. I'll spare you. So needless to say, new home sales are down about like 60% from the first quarter. When I've spoken to my friends in the new home sales tracks, they've told me that it's been pretty quiet. So just wait till we see the fourth quarter sales, if there are any. Now, just today, I saw that Ryland Homes is offering $25,000 in incentives if you buy up in Providence. Now, at least one home builder is finally seeing the light here. Some builders, like Lennar, who have been greedy and arrogant, have only paid realtors close to like half of what the other builders are paying. I've got a strong feeling that now that they need our help selling their homes, they're going to finally pay up and want to be best friends with realtors again. So let's just quickly wrap up what we learned today. Inventory levels are still skyrocketing at a disturbing pace. The current inventory is 81% traditional sales. Foreclosure activity went through the roof last month, but should grind back to a halt in October. The major banks are laying off and betting on a housing downturn for next year. Even hedge funds are walking away now and taking their profits. Major lending changes are on the way in January, which could drastically affect the market negatively. And new home sales are down about 60% from where they were during the beginning of the year. So what do we take from this? Well, if the people with billions on the line are betting against real estate next year, I guess so am I. Everything that I warned you about for months now is coming to fruition. If you're a buyer, you really need to be careful. If your debt-to-income ratios are high, then you need to get with your lender and make sure that you'll still be able to purchase what you want in January. Prices will drop, but just realize that you may be caught in a catch-22. See, the home that you want may be cheaper next year, but you might not be able to even qualify thanks to government changes. So if you're a seller, my position still stands. You should have sold when I told you to months ago. But from here on out, you're battling a declining market and now the holiday season, which is typically poor for sellers. If you have a home in the $400,000 price range, you're completely mental to wait until next year, since we already know the conforming rate limit is set to be reduced, along with buyers' purchasing power. So do whatever you need to do, but make sure that you sell off quickly. Now, thank you again for watching. Please click here to subscribe and feel free to contact me anytime with any questions or concerns you have regarding Las Vegas real estate. Have a fantastic October, everyone.